Hey, good morning, everyone.
Good morning.
Hello.
Good morning, Professor Long.
Hello,
Hey,
Professor.
good
Good
morning.
morning. Good
Good
morning.
morning. Good morning,
Good morning.
Abari. Good morning, Dimitri. Good morning.
Good morning.
Good morning, Piotr. Okay, good morning, everyone. I see 7 people here, and on my last check, how many people were in the forum? I guess about 7 as well. Looks like I have 9 people in the today's forum, right? So that means, I'm still missing. Okay, one more person is joining. Okay, so as you know, today is the last day of class. And since it is the last day of class, ideally, we should be, okay, let me go to the course material. Ideally, we should be uh, in topic 6. You might wonder why not topic 7. It's impossible. It's unrealistic. So I even made it, 15 weeks plus, right? Because there's no way we can cover it within 15 weeks. Actually, one semester is 14 weeks because of, some holidays and spring break and things like that. So this is just a very tall order. I mean, ambitious goal, and we can't reach that. Anyway, but topic 6 was already covered by the main lecture. If you have been following the main lecture diligently, they have already been, they were already released the last time. So, CAPM and APT, the last video was available on May 3rd. So that was like, 2 weeks ago, almost, so I would have to assume that you have studied the main lecture. We'll just have to do whatever we can, with the collaborate session, okay? And so today's, one thing, so back here, remember, I didn't get to quite correct covariance and correlation last time, but I realized why. Because the same thing, the same, mistake I made here, I made also here as well. So when you are doing this, it had to be the not the probability weighted return, but the original return. But somehow instead of D3 C3, I used D3 and I just copied it over. So once you correct this, drag it down, then everything adjusts here, everything. So we get the same result as what they have in the slide. Okay, you see? Oops, so the standard deviation came to negative. Standard deviation came to this, which is what I have there, right? That was correlation. Not the standard. Covariance and correlation. Correlation came to negative 0.49. So looks like the correlation between the stock and bonds are slightly negative. But I told you, but in the last class, you should remember, because I mentioned actually empirically and realistically, long-term bonds and stocks are slightly positively correlated. And what's negatively correlated is the short-term bonds and stocks, short-term bonds, and by association, short-term bonds and long-term bonds are also slightly negatively correlated, right? So between the long-term bonds and stocks, empirically, the correlation is slightly positive. And that is actually found here. So if we use historical data instead of scenario analysis, so we find let's see, we can find variance, covariance from covariance and correlation from historical data of stocks and bonds. But one little tricky thing is that the averages of past returns provide highly noisy forecast of expected return. In other words, what that means is mean from the past data are not very precise predictor of the future return, and that is of course we can't expect um, the mean from the average will exactly nail the future return, and it is quite theoretically it is quite obvious because I've been giving you the examples of when I gave you the example of the probability theory. I used, if you remember, I used it opened dice example. And if you remember, in that dice example, the mean of the or expected payoff from that dice game was 3.5. And obviously, there's no such number. Of course, 3 is the closest thing to the 3 is the closest thing to 3.5. However, then you can say also 4 is the closest thing to 3.5. But the reality is you will never, no matter how many times you throw the dice, you will never get 3.5. So again, so the mean expected return or mean is a kind of rough indicator. You cannot it will give you an idea. This will be rationally expected mean with the probabilities of 34% probability of that deviating from the mean within one standard deviation above the mean, and 34% probability of deviating from the mean within one standard deviation of the mean. So you can, but but in case of dice, the probabilities are all 1/6. I mean, if you keep rolling the dice so many times, if you keep rolling the dice for like 600 times, then you will see, even if it is, outcomes are only one of the 6, right? The outcomes that can come out of the rolling a dice is 1/6. We will have some standard deviation around it, right? We'll have some standard deviation, and if the standard deviation is 1, right? Of course, most like not don't I don't know what the standard deviation will be, but let's say if the standard deviation is 1, still you can you can say there's 34% probability that it will be 4, and 34% probability that it will be 3. Why? Think about it. On a dice game, right? Because only the integers can come out. It's going to be only the integers, right? The integer between 2.5 and 3.5 is only 3, right? Integer between 3.5 and 4.5 is only also 4, right? So we can assign the probability. There's 34% probably, that it will be. So the reality will be different, right? That's why expected return will be very noisy or imprecise, right? So we should focus more on the deviation from the average, and then realistic. So empirically, the realistic correlation between stocks and bonds based on historical experience is actually around 0.2. So I told you, actually, and when I said the correlation between long-term bond and stocks are slightly positively correlated, was based on the theory, not necessarily, based on the empirical data. And the empirical data actually supports my theory. And the theory is quite not only but also other economists can also theorize that, because you use short-term bonds and long-term bonds as like complementary instruments. And when the think about it, when one thing, you can one reason you can think about that positive correlation is that the yield curve, right? In the yield curve, right? When there is impending recession, if the recession is anticipated, there's a flight from short-term bonds to the long-term bonds, right? Therefore, the price of the short-term bonds fall, price of the long-term bonds go up, and then if the price of the long-term bond goes up, then the yield on the long-term bond will go down. Also, on the other hand, the yield on the short-term bond will go up, and hence resulting in inverse yield curve, right? Or inverted yield curve, right? Remember that? And the reason there is a flight from short-term bond to long-term bond is because they want to avoid the crash of the bond, short-term bond, when the recession hits. And of course, the recession is a relatively, short-term result of the short-term forecast. I mean, you don't know if there's going to be a recession in 10 years. You don't know. Or in 30 years, or in 5 years. I mean, recession, you can anticipate recession. You can tell if there's going to be a recession or not within, 2 years, under 2 years. But, long-term horizon, no way of knowing that. So you don't want to be stuck with the short-term bond that would be in a shamble. I mean, when the time comes to pay back, when the time comes to for the companies to retire this short-term bond, they will be in mostly they will be in liquidity crisis, right? So you want to avoid that. So you sell short-term bonds and move to long-term bond, and also you sell short-term bonds and put it also in the stocks. Of course, uh, uh, with that's with the intention of keeping it in the stock for long term. I mean, if you're a short-term trader, if you're a day trader, you wouldn't do that. But if you're an investor, not a day trader, then you would do that to weather out the recession. But anyway, so because of that, uh, you can tell that there is a kind of positive correlation between long-term bond and stock. Also, think about it. When interest rate goes up, of course, when interest rate goes up and goes down, everything, the valuation of everything will be affected in the same way. Relatively, but the short-term bonds, think about it. Short-term bonds are relatively not very much affected because short-term bonds, if you have less than 1 year left, uh, of course, discount rate will still affect, but you don't have you don't have a lot of things to be discounted, right? You don't have a lot of things to be discounted. Long term, if it is a long-term bond, there's a long series of coupons still to come, right? And they will get discounted really heavily, if the interest rate goes down. But just if you have less than 1 year left, what kind of coupons do you expect? At best, one coupon. And then even if you discount it by 7%, not by 5%, that the impact on the present value would be very minimal, right? That's why short-term bonds are uh, uh, money market instrument in a way, uh, or cash equivalent, because they have very stable cash flow, right? Stable valuation. So then, based on this, let's think about it. Um, let's move on to the next example. 6.5, this is 6.5, 6.6, example 6.5, 6.6. So what is this? I gave 0.2 here because this is empirical correlation. And this is expected return on the stock, expected return on the bond, standard deviation of stock, bond. Now we want to find the weight, minimum variance weight. So what that means is, so risky portfolio, we know risky portfolio consists of two components, uh, stock portfolio and bond portfolio, right? So return on the risky portfolio is a weighted average, right? We know it's weighted average, right? Weight of the and the weight of the we did that. We did this is the weighted average, right, of the stocks and bond. Weight. So our portfolio has, right? These returns have been already uh, weighted averaged, right? So now we can understand. What would be the variance of the portfolio, right? Now, of course, that variance is the variance of the rate of return, right? The portfolio return. So um, and think about it. Maybe in middle school, around eighth grade or ninth grade in algebra class, you may have learned, factoring or factorization, which is what, you would remember. Uh, if you have a plus b squared, or this is actually expansion, the uh, the other side of expansion is factorization. How do you expand something like this? How do you expand something like a plus b squared? Does anyone remember? How do you expand?
It's
Hmm?
gonna be a square plus 2ab plus b square.
You're right. You can put, normally you would say a squared plus 2ab plus b, but I would like to write it this way. Okay, that would be, yeah, you're right. And you remember a minus b squared will be a
It's gonna
squared.
be a square minus plus b square minus 2ab.
Yes. So is this Irina, right?
Yes, Professor.
Irina? Okay, Irina, so I'm gonna give you one point for extra credit. This is something you learned,
Thank you.
you're welcome. Today is the 14th. Okay, and so on. And you have, if you have a squared minus b squared, then that's actually it's the the other way around. Either way, if you have a squared minus b squared, it's actually a minus b, uh, a plus b, a minus b, right? And if you wonder, what really? Try that. As a squared, right? Then minus ab, then plus ab, and minus b squared, right? They cancel out, right? So now think about it. If you remember this, uh, and some people may say, "What? We never learned this." Well, in then you must be from this country and from public schools. And not, I'm not saying all public schools are like that. Public schools in the uh, there are wonderful, wonderful public schools, but some public schools in the uh, New York City, Brooklyn, Bronx, Queens, and there are horrible, horrible public schools. I'm not saying horrible in many ways, but especially in the academic achievement, because in those I believe it's much better now because uh, in in the 21st century, I mean, um, since 2010, right, post 2010, the math math achievement, average math achievement in the urban center public schools, overall USA, uh, has improved. USA was always like the in the International Math Olympiad. USA was always at the bottom, but now it has improved, uh, uh, a lot. But even until 80s and 90s, it was horrible. and some, public schools in those neighborhoods, uh, the best they can. A lot of public school graduates, high school. They graduate from high school. Their math level is barely above sixth grade, and their reading and writing level achievement is barely above eighth grade. And there is such a the culture of celebrating even the little achievement. I mean, in countries like South Korea, you would be shamed. You would be ashamed if you very little achievement is not an achievement. It's a shame. And I believe in most other countries it would be pretty much the same. But in this country, they consider that a positive reinforcement. Yeah, well, a lot of pedagogists are all always that's why the pedagogy is really really for kids, really for kids. For kids, yeah, a lot of those positive reinforcements would be motivating. But if you are a little smarter than just a kid, if you are at least a teenager, from that point on, positive reinforcement is only dumbing down everybody. It's like, because it's celebrating. It's only celebrating uh, nothingness. You have achieved nothing but, very little. Oh, you're great. You're good. You give awards to everybody. If there are 30 people in the class, you're Mr. Sunshine Smile. You're Miss Happy Smile. I mean, those are not, yeah, I mean, that's a good thing. I mean, those are positive, things about those people. But then they they don't want to study hard or accomplish anything other than just being themselves. And they say, "Oh, I'm proud to be myself. I'm being being myself is look, you can never." And then even in the college, all they say is that, well, I want to get a job I want to make a lot of money. But if you want to make a lot of money, and they all want to get a respectable job, but if you want to get a respectable job, you have to you have to excel. You have to excel uh, in abilities, right? It could be intellectual abilities or physical abilities or whatever. But then, if you are Mr. Sunshine, or if you have a sunshine smile or bright smile, how would that get you a respectable job that pays, a six-figure income a year? I mean, of course, if that bright smile is a gift, but that would be a gift that can be found in one in a million. If you have that gift of one in a million, yeah, you will become like a comedian, or very successful comedian, or um, an actor, a model that can make a huge income. But that's one in a million, right? In a classroom of 30, everyone gets some award for something, not for academic achievement, and they think the world will accept them as they are. This is false hope, and like pedagogists, right? Pedagogists, they only research the cases in early education, early childhood education. and they think they become, higher education administrators, and they want to run university with that naive idea about, from their research that, that was based on, early childhood education. That's what's pathetic about the public education in the urban centers. But anyway, as I said, since 2010, a math achievement level in the U.S. has come a long way, really. It's not like no longer like 80s and 90s public schools, urban center public schools in 80s and 90s. Now, anyway, so if you think about it, what is variance? Actually, variance, if you think about it, variance, or let me variance of the portfolio, right, is actually, if you think about it, standard deviation of stock, standard deviation of bond squared. Isn't it right? And so then you might think, so if the standard deviation is this 0.12, this is point whatever, let's say this was 0.8, then I just need to do this. No, you can't. Why? You can't do that. Why? Because there is, what did I do? What is this? Covariance, right? And then then there is correlation. There is correlation as well between stocks and bonds. So we will have to. And one thing I forgot to mention here is the weight. I didn't have to do that. Because a portfolio will consist of 60% stock, 40% bond, right? So there will be a weight of stock and risk, right? Standard deviation is risk of stock, weight of bond, standard deviation of bond. And we understand that, it's more than just, adding them up and squaring it, because we need covariance. And when you learn this in 8th grade or 9th grade, you never heard of correlation, but random variables, right, may be correlated, may or may not be. If there is no correlation, fine. If there is zero correlation, there isn't even covariance. If there is zero correlation, there isn't even but they may or may not be correlated, right? So we can't ignore that. So therefore, then if you work this out, then you'll come to weight of weight. Everything must be, the whole thing, this thing is squared. So weight squared, standard deviation squared. That's variance of the stock. Then weight of the bond squared, variance of the bond, and then 2 times weight of stock times weight of stock times standard deviation of stock times weight of bond. So I will just put all the weights first, right? Weight of stock, weight of bond, standard deviation of stock, standard deviation of bond, then times correlation between stock and bonds. Okay? So this is how you do that. So you see, that's the variance of, and then what we want to do is, so this portfolio has variance. This portfolio will have variance. And of course, when you have variance, of course, you have standard. Think about it. You want, and the variance will now depend on this weight, right? Arbitrarily, we chose, 40% stock and 60% bond, but we know, okay, so here, where am I? Okay. We can have weights like this, right? We can have weights, we can try out different weights. First of all, -2, this is the weight of stock, weight of bond. So weight of stock is 1 minus weight of bond. I mean, if we find weight of bond first, I mean, if we want to, if you want the weight of the bond to be 1.2, what does that mean? You short stocks. The weight of stock will be -0.2. And so then, this way, then stock will be shorted by 20%, shorted by 10%, 0, and then 1.09. This one will change later because I'm going to show you. And stocks can be 0.1, weight stock can be 0.1, 0.2. Then bond will be the complementary 1 minus, and then so within the range of 1.2 to -0.2, right? Let's see, depending on the weight, how the standard deviation will change. And obviously, the lower the standard deviation, right? So here the graph is empty, but I already built it in such a way that as we fill in the weight and as we find the variance and standard deviation and the expected returns, you will see a pattern. And then obviously we like the portfolio weight combination that will result in the minimum variance or minimum standard deviation. Isn't that right? We don't want volatility. Nobody wants volatility, too much volatility. Again, think about it. This says S. That's actually this sigma, but that Greek character, the symbol cannot be put in the label. So that was the. So excuse me. So we want to find the minimum weight. Minimum variance weight combination. Minimum variance weight combination. So how do we find the minimum weight? This is the formula for minimum weight, right? Here, I solved for weight of the bond, but I can do it the other way. I can solve it for weight of the stock. But if we find the weight of the bond, weight of the stock is 1 minus weight of the bond, right? So that's obvious. But this formula, The book just gave this formula. The book just gave this formula to you because when I always tell you, I'm a kind of person who cannot just take this as granted. How did they come up with this? Huh? But then so I actually cracked it. It's basically, if you have done microeconomics, you know uh, how to do maximization and minimization. In microeconomics, it's all optimization. Objective function. What is the objective function? There are only two types of objective functions: maximize or minimize. Usually, we want to maximize revenue, given and profit maximization is achieved by maximizing revenue while holding cost constant, or minimizing cost while holding revenue constant. Well, that's objective function. And then basically, first order condition is setting the first derivative equal to 0. Okay, so that means you want to find, this is the minimum point. To find that minimum point, right? Minimum point, it makes inflection point, right? At an inflection point, the slope of the curve, right? Whatever this function, and it's a quadratic function. The slope of that should be 0, right? So setting it equal to, that's the first order condition, right? Now, I put it like this, but when we are talking about, and if we set it, if I lay it on the side, why? Because the reason you lay it on the side is because this will be the return, right? Vertical axis is the return, and the horizontal axis is the standard deviation. Anyway, if the standard deviation is the minimum, right? Still the same first order condition, right? So I actually I figured it out how they came with this, how they came up with this, and so think about it. We all know there is a trade-off between risk and return. In other words, the higher the return, that means the higher the return, the higher the risk. So that means if you want, think about it. If you want higher return, right? Higher risk. But if we can find, but that's not efficient, right? I mean, if you go to, let's say, if you go to Princeton or MIT, Harvard, Yale, Stanford, yeah, you'll make, you have a better chance of making, getting a job with the startup salary of probably, 80K a year, 80K. But then that's the output, but the input to get to that point for 4 years, it cost you 200K, right? Before, let's say that's not a very efficient. It's like something like this. You're getting, this, for investing, something like this. And that's not even on the on this investment opportunity set. I mean, if the investment opportunity set is, let me try it again. Maybe so if the investment opportunity set is more like, if the investment opportunities, so anything on this curve is the possible combination of return and risk. So let's say, oh, you got a job that pays you $80,000, startup salary of $80,000, right out of college. You came out of, let's say MIT or Harvard. So, oh, you ended up with that job. It's like, 80,000, but that pays you 80,000. However, until you now you understand what I'm trying to say. Right? You understand what I'm trying to say. So but to get that $80,000 a year job for 4 years, you spent 200K. So actually, it will take you something like 3 years to recover, right? It will take 3 years to recover that, investment over 4 years. It's not that bad. I mean, if you can recover it in 3 years, I mean, at least if you recover it in 4 years, you still break even, right? But that's if you did the right major in those even if you went to Ivy League school, if you did something like ancient Roman history or classical literature or classical literature, Roman, medieval times, or pre-Roman, era classical literature, Hellenic classical literature. You went to Princeton, you went to Harvard, paying $200,000 for over 4 years, and you if you did that, I don't know what kind of job you'll probably end up in some library but you won't be making $80,000 a year. Probably making $40,000 a year. Then it will take how many years to right, recoup? So the point is, think about it. This is return risk trade-off, right? The higher the return, the higher the risk, right? However, if the so the point is, if you can, if you went to CUNY and after graduating, I mean, CUNY would cost probably, I think CUNY tuition is probably $100 per, not even $100, I guess, per credit. I don't know. Let's say over 4 years, it cost you only $20,000 over 4 years. Oh, that would be too understatement. I mean, per semester, How much does it cost per semester at CUNY? 6,000, 8,000? I don't know. If it costs $5,000 per semester at CUNY over over 8 semesters, so per year it's 10,000. 4 years, 40,000. 40,000 is still 1/5 of 200K. But after graduating from CUNY, you and doing a major like finance, you're likely to end up with a starting salary of like 60K. Then this is always, what is Sharpe ratio? Didn't I tell? Sharpe ratio is basically, Sharpe ratio is the slope. In other words, slope measures the input-output ratio, output to input ratio, right? So the higher the slope, the steeper the slope, the better it is. So if the slope is very not very steep here in this example, the slope is relatively flatter and flatter. It's getting flatter and flatter. But what if investment opportunity set was more like this, right? If the investment opportunity set upper, it doesn't have to be symmetrical. It doesn't have to be symmetrical like that. But if the upper range or upper side of the investment opportunity curve set looks like that, then it's very high Sharpe ratio, right? The Sharpe ratio is here is like this. Sharpe ratio here is like this. Sharpe ratio here is like this, right? So what that means is the more northwesterly it is, that means higher Sharpe ratio, or higher return risk ratio, right? Not Sharpe ratio, but return risk ratio, right? Because we're okay. Does that make sense? Everyone?
Yes.
So, okay. The mean variance criterion is so. First, we want to find this point, right? Because that's where the risk is the minimum. But of course, that's not necessarily the optimal point, because the risk may be minimal, but the return is not necessarily right very attractive. However, let's say we find a point like this, and this ratio, if you look at this ratio, that ratio may be that slope may be the the highest, right? Why? And then slopes later on are flatter, right? So in other words, we want to find the point that gives us the best mileage, right? Understand? We want to find, but first we got to start with the minimum variance weight. So that is the formula for minimum variance weight. And then let's find out what is the minimum variance weight. So first, this is the continuation of our example, the portfolio. What's happening? I think okay, I gotta close that. So our portfolio, our stock portfolio return and bond portfolio return standard deviation, this was already done in our previous exercise. So, what's going on? My keyboard is what sometimes keyboard isn't working today. So I'm gonna have to. I mean, my wireless keyboard. So something I bought from eBay. And I think the cheapest, yes, made in China. Of course, I'm not saying all made in China is crap. I mean, if I bought something more expensive, it wouldn't give me this headache. I bought the cheapest one. Okay, so since we all got that last time, so this is right. That's the return on the bond. So don't enter manually 10% or 5% because it's not exactly integer, right? It's showing you as if it is integer, but Excel knows whatever. In this case, it must be. But when it comes to the standard deviation, and the standard deviation of the stock, because you see, it does this. And I guess in the textbook, they used increased decimal. In the textbook, they used just as if they used integer, as if it is you see 19.8. So they used rounded number. If you use rounded number, then there's gonna be inevitably rounding error, right? So I don't want to manually enter those numbers, and because we already worked it out last time, why not, right? Why don't you take advantage of that? Okay, and then here, now let's find the minimum weight of the minimum variance weight. Minimum variance weight. I mean, I just say minimum weight, but because it's always mouthful. I mean, to say it fully, it's mouthful. So minimum, we use this. Okay, so it's variance of this squared minus standard deviation of bond times standard deviation of stock times correlation between the two, right? Okay, and then divided by standard deviation of stock, which is of course squared, n plus standard deviation of the bond. I mean, variance of the bond, and then minus 2 times standard deviation of bond, standard deviation of the stock, times correlation between the two. Okay, hit enter. You should get something. I don't know if this is correct, but let's check. 0.8937. No, something's missing. Something's not right. Why? when I did that before, I got it right. Variance of stock minus D2 C2 times E2 over C2 squared D2 squared minus 2 times D2 C2 and E2. Uh, this isn't exactly. But basically that's how you do it. I'm not sure why I'm getting this is significantly different from this. And when I did it previously, I got that right. And it's not due to rounding difference. So let me check. Let me check my original document. So this must be correct. I got it right. This must be correct. It could be because it could be due to the rounding difference, but so let me just use what they used in the yeah. If I use rounded number, right? I guess something like what they got there. $932. It's still a lot of 932. Oh, so I even did, I put 932 manually there because that's what the textbook has. But um, if I go by the exact number, it should be like this. So actually that's the minimum variance weight, right? That's the minimum variance of, if I got this, then weight of the stock should be like this, right? It's 1 minus. And then, so I have already built it in here. Expected return. Weight weight of stock times stock return, plus weight of bond times return of the bond. And then, of course, you got to lock A2 and B2 so that, as I scroll down, as I drag it down, it's going to stay. And variance, of course, we know what variance, weight of stock, standard deviation of stock squared, plus weight of bond, standard deviation of bond squared, plus 2 times weight of stock, standard deviation of stock times weight of bond, standard, and then, right? correlation. So the parameters that shouldn't change, they must be locked, right? And then this is square root of that. So once you are good here, now get ready to drag it down. But I'm going to give you a few minutes, a few seconds actually. It's 10:30. I'm going to give you 1 minute to. I don't think this is difficult. But this, okay? And also this, if you are trying to copy, A2, C2, no. Follow this, right? Don't try to copy my cell numbers. Go by the formula. So if you're okay with this, is everyone ready? Is everyone ready? Okay. Now let's drag it down. Highlight these 3 cells. Drag it down. Come on. More. Okay. So let's see. Yeah. And then since this is the minimum variance, there's a reason why I used yellow highlight there, because this is the minimum variance weight, and then that's where the return at that point is, where the standard deviation at that point is. And if you have completed this, your chart would have already completed and connected those points, right? So of course this is minimum variance point is here, where portfolio return will be 5.53. Standard deviation would be somewhere like 8 point something. But obviously that's not the most efficient. I think somewhere here, that would be the that's where it gives the highest slope, right? Or here, somewhere there. But anyway, we can also find out which one. So what you can do further is find the ratio between these two, right? Return risk ratio. And you can find where the return risk ratio is the highest. And that's the weight that maximizes our portfolio outcome. So the rest of it, I'm gonna put you on a break, and the rest of it is the same thing under different correlation coefficient. What if the correlation is -1? What if there is no correlation? This is our case, correlation. What if the correlation is 0.5? What if the correlation is 1? Perfectly possible. But that exercise, we're going to do that after the break. So its time is 10:42. We're going to take a 10-minute break. So return at like, 1052. Okay. All right. All right, we're back. We're back. So, I want you to continue. I want you to try this out on your own because it's the same thing. I mean, this exercise is what you did as before. I just it won't take that much time because it's only a matter of what you did already. And but in this case, we are using manually. Uh, uh, and 19%, 8% manually entered the standard deviations. Why? Because I wanted that to match. I wanted it to match what's in the right in the book. So you try that, and it's the same thing, but under different correlation scenario. This is the correlation we did. So basically, if you do that, and it's the same thing, variance under that, square standard deviation, right? And then when correlation is -1, correlation is 0, and then you do just the first row, drag it down, and then here now I'm using stock, weight of the stock for the minimum variance. Then all you need to do is switch uh, uh, switch the things. Previously I used bond for minimum portfolio. If you use stock for minimum portfolio, this will be a variance of the bond. This is the same thing. Variance of the stock, variance of the, this will still be the same thing. This is the only thing that will be different, right? And then I get the minimum weight, and then the portfolio return under that weight, with that weight, right? And then standard deviation of the portfolio, the variance. I mean, this is the variance of the portfolio. And the variance in this case, I think, yeah, variance will have to be 0 if the correlation is -1, right? If they are perfectly negatively correlated, that's that's not realistic, but that's an ideal situation. If asset X and asset Y, asset A and asset B are perfectly correlated, negatively correlated, then they cancel out each other, right? The variance will be canceled out. The variance of both will cancel out each other. So that's why negatively correlated, if two portfolios are negatively correlated, variance is 0, standard deviation is 0, right? And then so look for these results, right? If you and then if you did it right or wrong, you will see if the result matches, if these results match the result here, you did it right. Okay? And if the negative, perfectly negative correlated, positively correlated, perfectly positively correlated, in that case, right? Negative 0.727 minimum weight, right? And then portfolio return, portfolio standard deviation. Somehow this is, I think this is not the case. Usually this is not the case, but somehow it's because there's I don't know, but I got the same. Yeah, negative 0.27, 1.360. Usually, if there's a positive correlation, then this actually doubles it doubles the variance. It will double the variance, but somehow this is how it turned out. So, okay. This is what it is, right? This is the minimum variance portfolio, right? I mean, a minimum. So if it's still, think about it, you are combining bond, stock and bond. So you might think, oh, then the risk will be somewhere in between. You might think, oh, because you're combining stock portfolio and bond portfolio, the standard deviation of the portfolio will be somewhere between the standard deviation of the stock portfolio and standard deviation of the bond portfolio. No, actually, no. Why? It's actually better. I mean, it's better than, in terms of, look at this. The result of the portfolio is, it's really the standard deviation is even lower. Standard deviation of the portfolio is even lower than the standard deviation of the bond. So what an improvement. I mean, that means this achieved by constructing, this is, right? Even standard deviation is even smaller than bond standard deviation. And of course, in terms of return, right? Of course, it should be higher than the bond, right? And then, as I said, actually, the more northwesterly you go, it's preferred. I mean, at this variance, if the return is somewhere here, oh, that would be wonderful. But that's not possible. That's unfeasible. What is feasible is, think about it, something like this combination of return and risk is unfeasible, right? That's unfeasible. What's feasible is whatever is along this investment opportunity set. If it is on this curve, it's efficient, right, at each point, and anything inside is still feasible. Anything inside, this is a feasible area, right? Portfolio Z is feasible, but it's not efficient, right? Why? Because for that risk level, You see what I mean, right? For that risk level, you can do better. Here, you're here, you can do better, right? Now, and under, actually, this is showing you what it would look like. What would the investment opportunity set will look like under different correlations. If the correlation, so obviously, if this is this one, the correlation is -1. Gray is when we did this, gray, right? We did this. And when there is zero correlation, this is when there is zero correlation. This is when there is correlation of 1. Yeah, this is perfect. Oh, 1, if there is a correlation of 1, there will be a 45-degree line. This is exactly 45-degree, right? 45-degree angle. 45. It's obvious because when x increases by 1, y increases by also 1. So it would show a perfectly symmetrical 45-degree. Now, so if you try out different, right? Oops. So I've been telling you always, when we are dealing with the portfolio, it's always the question of the Sharpe ratio. The higher the Sharpe ratio, that means the steeper the slope, right? The higher the Sharpe ratio, the steeper the slope, right? If okay, and of course, the difference between Sharpe ratio and price of risk is standard deviation or variance at the bottom. So we know what risky portfolio is. Risky portfolio is stock and bond portfolio, right? Stock plus bond portfolio with the weight. Optimal risky portfolio is the one has the highest mileage, best combination of risky and less risky. I mean, you cannot say bond is safer than stocks, but it's still kind of risky still. Less risky. I don't know if this is. Because a safe asset is risk-free treasury, right? Risk-free treasury bill. That would be. So the best combination will maximize the Sharpe ratio. Think about it. If it is optimal, right, it will maximize the Sharpe ratio. And what's a complete portfolio? Complete portfolio is optimal risk portfolio plus risk-free asset. Treasury bill, right? And I talked about it. So we know how to then how do you find the Sharpe ratio maximizing weight? This is how you do that. This is how you do. If you think about, oh, it looks kind of familiar. Well, it's like a combination of this. It's like a combination of this and this, right? Like a combination of this and this, right? And what is this? Risk premium, right? So bond risk premium, and this is stock also risk premium, stock risk premium. Uh, so it's not. I may have misstated it. It's not exactly a combination of two. I mean, it's the combination of this and the risk premium. Okay. Oh God, it's it's so humid. It was so humid yesterday and so humid today, and looks like a nice day today, but I guess it's very humid outside. Uh, and where I live, this building, they can cut off if they don't, they're not yet, turning on the central, uh, central, centrally, central heating and air conditioning. So centrally climate controlled, and they don't turn on the AC yet. But if they don't turn on the AC yet, but at least they can shut down the heat. But they don't. They didn't. So it's really unbearable where I am. So now we understand what is what we understand what is meant by dominating, right? Here we already talked about this here, right? If put return portfolio return on portfolio A is higher than, right, return on portfolio B, and the standard deviation on portfolio A is less than standard deviation of B. For that to happen, A should be more northwesterly, right? A should be more northwesterly than B. Clearly, higher return, lower risk, right, than B. So then A dominates B. That means A is always better, superior to B. Um, so if we, apply that to that concept to capital allocation line, right? and this is something we capital allocation dominates capital minimum. So, but this one is, A is not necessarily more northwesterly than the minimum variance point, but as far as the capital allocation line is concerned, right? This is capital allocation line, A, and the capital allocation line, the slope, in other words, slope, Sharpe ratio, is that means slope is higher, slope is steeper, and the higher, the steeper the slope, that means better gas mileage, right? Better it is, right? That's what it is. So that's all. Same thing. Now the complete portfolio, and by association, we have optimal risky portfolio, and our optimal risky portfolio will give us. So optimal risky portfolio is the best weight of right Sharpe ratio maximizing weight of stock and Sharpe ratio maximizing weight of stock and bond, right? It's the optimal risky portfolio O is the result of Sharpe ratio maximizing weight of stock and weight of bond, right? It's the result of, right? And then our complete portfolio will have lower return than that, of course, because by adding a risk-free return, and risk-free return is, of course, lower than risky assets return. However, because risk-free return has zero risk, right? Complete portfolios, risk standard deviation would only be this, whereas optimal risky portfolios return is something like this. So we have smaller, clearly smaller, we have smaller return, also as well as smaller standard deviation, but Sharpe ratio is the same. Basically, it's the same capital allocation line. Sharpe ratio of complete portfolio is the same thing, same Sharpe ratio as, right? In other words, as that means the gas mileage is the same, right? The gas mileage is the same. So that way we so it's like this. You have two cars. One is a big SUV. The other one is a compact car. But even if so, big SUV will use a lot of gas, of course. But but let's say that big SUV gets both gets, let's say 40 miles per gallon. Both gets, 40 miles per gallon is a great gas mileage. Only compact cars get like 40 miles per gallon. But if the SUV, this big SUV, a giant SUV gets 40 miles per gallon, they are, as far as the efficiency is concerned, they are the same, right? So the optimal risky portfolio is like that giant SUV, and complete portfolio is like a compact car. You think, giant SUV has, if the most of the, in reality, the giant SUV will have much flatter. The giant SUV will have much flatter uh, capital allocation line, or a lower Sharpe ratio. But let's say if they are the same, they give the same Sharpe ratio, they are the same. Okay. So if we so then we can determine, right, by using how do you find this? This weight, that's y. You know what to do, right? This is the complete portfolio, right? You find y this way, right? And then if this is 45%, if this y is 45, then 1 minus y will be 55. And then out of that 55, we find, Sharpe ratio maximizing weight. And from this, so I think the direction of the arrowhead is wrong. So from this, Sharpe ratio maximizing weight of bond and weight of stock. Right? Okay. So this will be the efficient diversification of our portfolio. Okay. And of course, inside the stock, inside the stock portfolio, then how do we, so how many stocks? Yeah, and how many sectors? So number of, as a rough measure, at least, you saw, right? About, if you have about, right, 20 sectors, if you diversified by more than 20 sectors, that will bring down the unsystemic risk to zero. It will bring down the unsystemic risk to zero. In other words, that's as far as you can, and then the rest of it is, systemic. systemic risk, you know. Efficient diversification with many risky assets. So multiple, you know, stocks in the stock portfolio and multiple bonds and bond portfolio. How do we achieve that efficiency? So graph representing set of portfolios that maximizes expected return at each risk level of the portfolio if that's what, you know, is the efficient. That's what is efficient frontier. Maximize risk premium for any level of standard deviation, or two ways to achieve that. Maximize the risk premium, max risk premium for given any given level of, minimize standard deviation for any given level of risk premium, one of the two ways. And then, or maximize Sharpe ratio. Of course, we know how to do this. Optimal portfolio capital allocation line must be tangent to efficient frontier. Once again, in this example, yeah, capital allocation line of A, portfolio A, is better than, higher than. In other words, slope is, but this is not the efficient one. This is not the efficient one. Why? Because it's in the feasible area. It's in the feasible area. I mean, it is efficient only at this point, but you know, if you extend it a little longer, if you extend it just a little more, any point on it is not efficient, right? Any point on it is not efficient. But if it is here, 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 it's all feasible and efficient. Anything below it, it's feasible but not efficient, right? So it has to be tangent. Optimal portfolio must be tangent to efficient frontier. So preferred complete portfolio and separation property means, you know, separation, it implies that portfolio choice can be separated into two tasks. First, determining, you know, optimal risky portfolio is, it's a purely technical problem by analyst, right? You know, we've been doing this under the, you know, this Sharpe ratio maximizing first, you know, by minimum, finding minimum variance weight, and then further by finding Sharpe ratio maximizing weight of bond and weight of stock, right? And then it's a purely technical. And then personal choice of best mix of risky portfolio and risk-free asset. I don't know why they say this is a personal choice. Again, best mix of risky and risk-free asset. I mean, we can find that weight, right, by that, you know, formula, right? So the stock portfolio, we have assumed that the stock portfolio, uh, we haven't we haven't, contemplated a lot about, how many assets, how many stocks should be in the stock portfolio. Uh, but we just assumed that the stock portfolio was, sufficiently diversified, like with 20 or more sectors. Uh, but let's see how we can find, the best combination, uh, the best weight combination, uh, or in the stock portfolio, right, of different stocks. So first, we assume basically two stocks, stock A and B. If you have two stocks, right, uh, we can gradually move more northwesterly. Uh, Obviously, when we have stock A and B, um, the minimum is this. Minimum variance of A is this. Minimum variance of B is this. But by combining the two, we can arrive at the efficient. Um, this is A and B can uh, both touch on it's what should I say? A and B have common, common denominator, which is E. This point E also lies on the efficient set of A, efficient frontier of A, and also lies, it touches on, is tangent to the efficient frontier of B. So the combination of the two um, satisfies both A and B, and also uh, the move is more higher, more northwesterly. I mean, uh, think about it. Risk is much lower than stock B, right? However, risk is a little higher than stock A, but the return is better than stock A, right? So it's basically, uh, curve passing through A and B, right? Which is, this black curve, uh, and curve passing through B and C. So, I mean, you can read this. You can read this up later, but the point is, the movement will be uh, more, it will be satisfying both, and move will be more northwesterly, you know. So, right. So, in other words, the efficient frontier will move efficient frontier will move more to the northwest, right? So it improves the Sharpe ratio uh, of this stock portfolio. Okay. Now, uh, okay, I try to summarize, because if, to cut through all that verbiage, and trying to sum it up in a more intuitive way. When I say intuitive, that means it doesn't require uh, too much verbal explanation. It should be obvious, by just visual cues. It should be obvious. That's something intuitive. But I believe that should. So verbally, I cannot do a very good job verbally, but intuitively, I guess you got that. So the time is 11:33. So I think it's a good time to take another 10 minutes. So let's take a 10-minute break and return by like 11:45. Okay. Alrighty. So let's take a 10-minute. All right, we're back. We're back. Okay, I guess during the break, someone left someone, Abraham Garcia, okay, was saying, me laptop? You mean my laptop, right? Me laptop is dying. I only have, okay, first, Professor, comma, my laptop is dying, period, right? And then start with, a period. The sentence is, uh, once is closed here, and start with uppercase. I only have 4%, period. Look, I don't know if you have a charger with you or not. Usually, you must have a charge cable and, wall charger or whatever. I don't know. Your laptop is only running on battery, but your responsibility. It's your responsibility to keep uh, a steady power supply to your device. Okay, that I hope you would come back soon, but that cannot be an excuse, right? Um, to uh, leave early, or especially today is the last day of class. Oh, one more thing. Well, you all know. You all know. So how many are here? Uh, okay. Some people are very late, right? Some people are like 10:30, 11:30. That's very late. Now everyone knows that the final is starting 5:15 is tomorrow, right? I will start tomorrow.
Yes, Professor.
Yeah. Uh, what was that? You were just confirming. You were just, yeah. It's gonna start
Yes, I'm
tomorrow.
confirming. Yes.
Yeah, yeah, yeah. And you're gonna have 3-day window, right? There will be no late submission. This is final. Make sure you have to finish it by the deadline. After that, no late submission accepted. Okay, there's no late submission because everything has to close, right? I cannot wait. I cannot wait. The grading. This is final. I have to submit grade. And grading has to be done.
Professor, I have a
Uh,
question.
yeah. Listen first. Grading has to be done simultaneously because that's the only way I can have mean and the standard deviation, right? If some data don't come in, I will have to do it with the data that I have as of midnight, uh, May 17th. So that's why I cannot wait for the late submission. Okay, if so, everyone's work will automatically terminate if you're still in the middle of, if your final is still in progress, if you're still in the middle of doing it at 11:59 p.m. Tuesday, 17th, you think, oh, I can submit it, maybe 5 minutes late, 10 minutes late, 1 hour late. No, it will automatically terminate as is. Okay? You think, I can probably I can still get a grade. No, you cannot get a grade because mean and standard deviation cannot be calculated if I don't have the data. Mean and standard deviation must be calculated with full data as of 11:59 p.m. So if you still don't understand that, maybe in other class, you think, oh, if I get 90 on this, I'll still get 8. No, there is no such thing. It all depends on the mean and standard deviation of the weighted average. Okay? So make sure that you submit it. There's no by the deadline because there is no late submission, right? It will just, if you can't submit it by then, it will just be automatically submitted as is. Okay? All righty. So what was the question someone was asking? Someone had a question, right?
Professor,
Yeah.
it's Alpha. So the 15 and it closed on the 17th, correct?
Yeah, I always give you like 3-day window.
Correct.
Hmm?
Got it.
But you have only like during that window you have only like 130 180 minutes. What does it say?
So it's three attempts, correct? Or 2 attempts?
2 attempts only. 2 attempts. You have only 120 minutes in a single sitting, right?
And could you please tell us how many questions will we have?
I'm not. Probably 25 questions. I mean, if I give you 120 minutes, probably 25 to 33 questions maximum, right?
Thank you. Because used to be we had
Mhm.
like 50, I believe, questions, and 2 hours is not
Yeah.
enough.
If I give you 50 questions, I will give you also like 180 minutes accordingly, right? But it's 120 minutes, so it would be something like 33 questions max. Okay.
Thank you.
Mm-hmm. All righty. So where was I? Okay. So you can, the rest of it is, okay. So we know already, why um, in, multiple asset case, in the more assets, the more stocks you have in that stock portfolio, the envelope of all these, efficient frontiers envelope, the more you have it, it will move northwesterly. Okay, so achieving higher Sharpe ratio. So you can just read about, and this is something already also. This is something also mentioned in passing in the when we did stock, the uh, theoretical basis for mutual fund industry. A few portfolios are, are sufficient to serve a wide range of investors. Uh, and if optimal in extreme case, if optimal portfolio is the same for all clients, management is more efficient and less costly because one management firm can serve a number of clients with relatively small incremental administrative cost. Okay, administrative cost. Yeah, I mean, if optimal, if, so I should say it's very big if. Okay, what I'm saying is if and only if the optimal portfolio is the same for all. But we know in reality that's not the case, right? That's not true in reality, but that's extreme case. So that's why there are many different fund managers. When different managers use different input data, of course, then different efficient frontiers there will result in different efficient frontiers and different optimal portfolios. So that's the real arena for competition among portfolio managers, right? whose security analysis is the best, whose security analysis produce the best input estimates, right? Uh, so in reality, right? Uh, so if there are many, some portfolio managers are very, their analysis is poor. If that is the case, then passive portfolio management is better. You remember from, stocks, when we did the stocks, passive strategy and active strategy, passive management, portfolio management, active portfolio management strategy. What does that, you know, indexed fund, I mean, market index, you just emulate the market index, then um, a lot of times, indexed portfolio is, much better than poor quality active management. This is, international diversification example, right? Uh, 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 the across different countries, and um, you will see which one is the most northwesterly. UK seems to be, efficient. So you please read it up, and I don't have time to go over this. Um, Efficient frontier. If you diversify with globalized, or international, a global portfolio, globalized portfolio, I mean globally diversified portfolio, right? You achieve this efficient frontier, which is, better than, it's more northwesterly in many ways, and uh, UK portfolio alone is like this US portfolio, and France here, Germany here, uh, uh, you can tell they are higher in return but higher in risk. Japan, lower in risk but lower in return. China, very risky, but for the risk, it's not that, not better than Germany, right? But if you, read. Uh, Now that brings us to the finally. This is the prelude to CAPM, but this is a quite um, um, a very solid basis for CAPM, and single index model. Sort of like, related to passive strategy too. So what is an index model? Uh, Relates stocks return to return on the broad market index, and we're dealing with excess return. So in other words, um, so here, let me go straight to, okay, it's like this. RD, we're basically, excess return on stock I, X, so, normally if it is the stock return, just simply stock return, I use lowercase r. But if it is this, that's excess return, right? So excess return on I is basically this is individual stock return. Excess return I is okay. Ri minus Rf. That means also Rm, market excess return, right? This is market return, market excess return. So market return minus, right? Okay. And beta is the correlation. Beta is, of course, the correlation between the two. Beta is the correlation between the two. So that means if there is a correlation between market excess return and individual stocks return, right? It is expressed in, captured in beta. And then alpha is this is the excess return that is not explained by not explained by the market excess return. So here, alpha is stock's excess return beyond that induced by the market index. Okay. Okay, but before explaining alpha, firm-specific or residual risk is something that is a component of return variance independent of the market factor. So firm-specific returns are unsystemic risk, right? Then systemic risk is captured by beta. Systemic risk is beta captures basically what is the systematic correlation between, what's the systematic correlation between market return and the individual return. But what it doesn't, it cannot, systematic factor cannot be captured. What systematic factor cannot capture is the firm-specific risk, right? So the firm-specific risk is represented by error term. E stands for error, forecast, in other words, forecast error, or residual. It's called residual. And then alpha is still, or even after accounting for the error term or the residual factor, residual risk, if there is still something beyond what is explained by beta, that's alpha. Alpha is actually what everyone wants. I don't know if you have ever read a paper, Hunt for Alpha. It's like Hunt for Red October. There was a movie, I think back in the early 1990s, there was a movie, I think it was a 1993 movie, starring Sean Connery, Hunt for Red October. And this is a movie about a Soviet admiral defecting to the West, and Sean Connery played that role. And he was the captain of the Soviet nuclear submarine, Soviet nuclear submarine. He was planning to defect to the West with that submarine, nuclear submarine. So it was 1993 movie. So the whole story was based on something like Cold War plot. And then in that movie, and the title of the movie was Hunt for Red October, because that Red October was the name of the nuclear submarine. And it was about that time when this article came out. There, so it had a ring to it, Hunt for Red October, Hunt for Alpha. Why hunt for alpha? Well, basically all portfolio managers are seeking alpha. Because why? Because alpha is something that gives, of course, if the alpha is positive, that gives superior return. Abnormal. That's what gives the stock abnormal return. Abnormal in this case means positive. It has a positive connotation. Abnormal, superior return. So I mean, it wasn't a revolutionary article or anything. I mean, that's something everyone knows, but everyone, but it just made a case for a clear case for alpha. Um, so if I put it, we can algebra of that model, single index model, can be expressed this way. So excess return on stock stock I, is basically beta times excess return on the market. So this is the part that is explained by systematically. Now, you remember when I categorized returns, I first, it was systemic and unsystemic. And the word systemic is different from systematic, right? And the systemic in that sense means, economic system, something coming from, something inherent to the system, something coming from the system, right? That's what is meant by, what did I touch? But also, the terms systemic and systematic are used interchangeably in finance, although they originally mean two different things. Systematic means something done systematically by It's called also systematic in the sense that explaining excess return by beta and the market excess return is a systematic process, right? It's a systematic process, hence also called systematic. Now, and then whatever is not so think about it. I'm gonna have to okay, here. This graph is showing you a better explanation. So if market excess return is 10%, systematic projection, systematic forecast is 20%. Okay, so this is RD is excess return on del, right? Of course, RM is systematic. RM is the excess return on the market. So if market's excess return is 10%, del's excess return should be 20%. I mean, if that means, what does that mean? Beta slope is 2. If the slope is 2, I mean, if beta is 2, then this is what you can forecast or project based on the market's excess return, right? This is what you can project or forecast about del's excess return based on the market return and beta, right? However, when market return was 10%. Dell's return was actually negative. It was something negative, I don't know, maybe -5. So what is this? This is called error. This is called error term. Every time the error is different. So in this case, what would this be? Market's excess return seems to be 18%, and according to the forecast, I mean, if beta is exactly 2, it should be like 36, right? If beta is exactly 2, but beta is obviously not exactly 2. But let's say anyway, Dell's excess return was 30 something. But I mean, according to the systematic model, right? Or this slope, this line is basically the slope, and this line is called security characterization line, SCL. So according to, and systematic forecast is that if Dell's market's excess return is 18%, it will be something like 30 something. But actually, the reality was that it was like 28. So the difference is also error, right? That's firm specific risk, right? That's firm specific. Makes sense? That's firm specific risk. And then, so all of these, and then when markets, this is what? When market excess return is 0, right? Market excess return is 0, right? Even when the market excess return is 0, Dell is still it has like positive. In other words, when there is no, that's the point where beta is 0, isn't it, right? That's the point where beta is 0, right? If beta is 0, market, the beta times market risk return is 0, right? In other words, as 0 correlation, right? With 0 correlation, still, when market excess return is 0, if Dell has still 5% excess return, this already puts Dell's excess return on a 5% saddle. I mean, Dell's excess return is already saddled on, what should I say? It is already saddled on a saddle. It's already, installed on a saddle of positive 5%. So everybody wants, think about it, it's clearly, if alpha is negative, it will show if alpha is negative, the SCL will be like this. And you would prefer positive alpha to negative alpha. It goes without saying, although the slope is the same, the overall trend of the returns, from the returns plot, you can tell, oh, no, this one is preferred to this one. That goes without saying, right? That's what alpha is. And then we're out of time. So basically then think about it. So this is how, now, expected return, excess return on del, given the market return, it can be explained exactly like this. However, when it is expected, that means, expected error term is 0. This thing is 0, which means, white noise. In other words, error terms will eventually average out to 0, right? There are positive, negative, positive, negative. Error terms will average out to 0 as 0. So that's called white noise. So you will be left with only, alpha and beta times market risk. Then that's the expected return. Then the variance, in terms of variance, is the variance of alpha, variance of systematic part, and variance of error. Alpha is not systematic. Alpha is not systematically explained, but variance of beta times RM that's the systemic risk or systematic risk, and then so that's beta squared times variance of market excess return, and then this is firm specific risk, right? Of course, we are talking about just one company, Dell. So we will, we will have this term. But if we have a portfolio, firm specific, you all know that firm specific risks can be diversified away in a well diversified portfolio. Okay. And then, so think about it. This is quite like CAPM, but the only thing is that in CAPM, the variables, independent variable and dependent variable, are just stock return, not the excess return. But you will see excess return is what? Okay, excess return is if you have alpha plus beta RM. Then think about it. Excess return is actually we're already out of time, so my mind is really not, getting so distracted. Right? Isn't it right? Excess. So if you then think about it, if you move this to the right-hand side, it becomes what? It becomes CAPM exactly, because then it becomes, the whole thing becomes RF beta, right? It's Kappan, actually. Okay. So, and the interesting thing is, so if we think about variance, right? Variance of the variance of the portfolio is basically, I mean, the variance of the risk premium is the systematic part and non-systematic part. So if we can take the ratio of the total risk with systematic risk, right? It's basically the systematic risk over total risk, which is, right? And that is called, here it's called, correlation. I mean, think about it. If this ratio is high, that means there's a high correlation between the two. Isn't it right? But correlation is this. Greek character rho is actually Roman R, Roman alphabet R. And in Roman alphabet R, it's called R squared. R squared means, goodness of fit. Think about it. If there is a high correlation, if there is a very high correlation, if the correlation is 1, wouldn't all of these plots fall exactly on, wouldn't all of these fall exactly on the SCL, security characteristic line? If the correlation is 1, there will be no error, right? Everything will, so the entire variance of the portfolio can be exactly explained by, it will be exactly explained by, if the ratio is 1, all of the variance of the, not portfolio, all of the variance of the risk premium can be explained by, the systematic part, right? If R squared, so the higher the R squared, the fit is better. The higher the R squared, the fit is better. You don't see scatter plots so wildly scattered away from the SCL, right? Now there are a lot more to, we're out of time. So that's all the time we have. I want you to, oh yeah, the last thing, beta is a correlation coefficient, but then we know correlation coefficient is rho, and what's the difference between beta and rho? Here, in beta, if it is beta, it's the variance at the in the denominator. If it is rho, we know it's covariance between whatever x and y, and then standard deviation of x, standard deviation of y. Okay, that's the difference. Okay, variance of x is, we know it is variance, but suppose, in correlation, right? Think about it. If this was x, then it will be this. If, right, will be this. So that's the difference between. The different, that means, mathematically so, but what it really means is, in rho, both x and y are randomly moving at their own, in other words, they are both independent variables. However, in beta, X is independent variable, and therefore Y is dependent variable. So Y cannot vary on its own. Y is the variation in Y totally depends on X, okay? But in rho, they don't depend on each other, right? That's the difference between. All right, so that's all the time. It's already 12:30. I don't know how many people are still hanging in there. So, all right, if you have any questions, then please email me, because I'm already 15 minutes past our scheduled time. So have a good luck with your final, and I hope you have enjoyed this semester.
Thank you,
Okay.
Professor Han.
All right. Take care.
Thank you,
Take care.
Professor. Thank you for your
All
classes.
right.
Thank
All
you.
right. You're welcome.
Professor, I have a
Take care,
question.
everyone. All right.
I have a question, Professor.
Who was Alpha?
Yes, sir.
Okay, Alpha.
So today,
Hold on. Let me stop recording first. Okay. All right. All right. Good luck, everyone.